Hi, welcome back to Academic Market Insights. I'm Dr. Russell Rhodes, joined by Dr. Larissa Adamiec. When we started doing these, we were both at the Kelley School of Business at Indiana University. One of us is now at Purdue, not the one wearing the Purdue shirt. I have a Purdue shirt because I have a child at Purdue now as well. But now we're kind of like a house divided. We're going to continue to do these videos. If anything, it might be nice to get perspectives from people at a couple of different schools as opposed to the same school. And with that explanation of why I'm not wearing IU stuff, we're going to get into the second part of talking about retirement planning. And we're going to talk about the accumulation phase, which everybody likes. It's the making money phase. So with that, I will hand things off to Dr. Adamiec, and she will run through kind of quickly things you should know about the accumulation phase of your financial life.
I will say the one challenge with the accumulation phase that I don't think people really like is that you can't spend it. So when you're thinking about the accumulation phase, we're not thinking about the consumption part of that. We're thinking
Mhm.
about savings. And that's not nearly as much fun. We like to go out and spend money. You can just
It's
ask for it.
it's it's accumulation and holding on to.
Yeah, that's the second part that's the tough
Yeah,
part
there we
because
go.
new toys are always fun.
Mhm.
Always. Okay, so we're going to talk about our working years, our retirement age, our investments, and then calculating how much money we realistically need. And Dr. Rowe, you're going to enjoy that because that's where we have some more of our financial models. And this is where we start to
Ooh.
do some of the net present value and think about really how much money do we need in retirement. Okay, and this was shocking. 30% of Americans have less than $25,000 in savings. Now, this is outside of their house and how much their house is really valued. But it's really, we have to start
Mhm.
thinking about what is the total amount that we need. So when we think about accumulation, we have to make sure we have enough assets to cover in retirement, an investment plan to achieve that amount of money. And then, and this is something that I really hadn't thought about, what is the plan to distribute those assets once you get to retirement age?
Mhm.
You know, and it seems obvious, but it's not obvious. You know, how much are you going to draw down every year? Legally, how
Mhm.
much do you have to do it? So,
Mhm.
our factors affecting our retirement planning include our education levels, our work life expectancy, and then our retirement life expectancy. And one of the things that is thought of frequently is that the more education you have, the more revenue you're going to earn. And this is just a rule of thumb. I'm going to put in my own opinion about this, and I'll be curious if you agree or disagree. We both work in the finance industry, and before I went on for my doctorate, I was actually making more money with just my master's degree. And so
Mhm.
I want to make a caution, depending on what field you're in, it might not really be that financial sense to go on for your doctorate. And part of it is not only salary expectations once you graduate, but also the amount of time that it's going to require and any potential costs. So if you have to take out loans for these degrees, I really want you to think about whether or not it truly makes sense for you in particular. It did for me, but that doesn't necessarily mean it does for everybody. Dr. Rowe, your thoughts on that?
Oh, well, it's really nice to be called doctor.
It
Um,
is.
but yeah, there's the academic space once you it was is really where you're gonna get the kind of stability that the PhD is gonna give you, and you might not make as much money, if as you did when you were in the financial industry. I don't make as much money as I did when I was working at hedge funds, but I got a lot more job stability than I had back then. And when we take a look at like the performance of the S&P 500. We often like to tell people if the market sells off 20%, you got to make 25% just to get back to break even. Well, if you're if you're in an industry where layoffs periodically happen, and we even did one about the financial industry having frequent layoffs, you're going to have to dip into that savings.
Yep.
So I do think that people are probably making more in industry with master's degrees than people in the academic space make with their PhD. But in the academic space, especially once you've established yourself at a school, you really I hate to say it this way, but I feel like sometimes you really have to go out of your way to lose your job. I'm not saying you can skate by either,
No.
but if you're doing the things that are expected of you in a university setting and you have your PhD and they're pretty set out for you,
Yep.
we both worked at Indiana together and we both knew what the expectations were on a frequent basis. So, it the stability thing as you work your way up that is not necessarily the amount of money, but that the consistency in the money that you're going to make over your earning life.
Well, and that's something that we're going to talk about with when you're starting to plan for retirement in the distribution phase is
Hmm.
when you have uneven cash flows. So one of the things that, particularly if you're working in the financial markets, you might have a base salary and then you have a large bonus once a year. That
Hmm.
cash flow is uneven. You don't know what to expect, and it's only once a year. So it really does change the dynamics of how you do personal budgeting and savings.
Hmm.
Okay, so your working years, you really need to think about how much you're saving every year, the principal or and the rate, the time of the savings, your investment earning rate. So it's a rate of your salary from how much you're saving. And then you also have a rate for what you're generating from those investments. Inflation rate, and then your maturity. How many years do you have left until it actually you need to start
Hmm.
distribution, and how much from that drawdown? I thought this was interesting. So this comes from the Social Security Agency, and it really maps out how the ages have changed from retirement. And the bottom is the year that people were born. So people born in
Oh, okay.
1960 are looking at a retirement of 67 or at 67. And we can see that it's looking like a sharp trend upward. I suspect that as we start to age out, that this is just going to creep up more and more, which then theoretically would mean that the retirement period itself would be shorter, but the accumulation phase is going to be longer. So, and also we're not going to talk about the distribution,
Mhm.
uh, but it's really important to really start to think about that. So annuation.
Oh, I wanted to ask a real quick question. I was trying to find
Okay.
the raise hand icon and I couldn't find it. What age do you think? I know what I was born in 1967, so we can use me.
Okay.
I have always assumed that I would be working to 70. That's just something that I've always had in the back of my mind, even though 65 was kind of the number that we always heard of when we were growing up. Um, yeah, and so I do think that 70 is the next thing. I think in China they just recently raised it from 55 to 60. And it was 55 to 60 for factory type workers that
Okay.
whatever work you're doing is very hard on you. But they actually they segment it out by what you did professionally. If you had a blue
Okay.
collar job, you can retire earlier. And again, the academic space, there are people well beyond 70, and I know you're relatively new down there, but there are a couple of people that are beyond 70 years old that I'm working with at Kelly. So you can work beyond those ages. And really, my whole question after all that going around was, when have you ever like targeted when you thought you were going to retire,
And
age
it's funny
wise?
you should say you said 70. I always thought it'd be 72 or 73. for
Okay.
me.
Yeah.
Um, it's creeping up that way.
Yeah. Yeah.
And
I target 70. So, and
yeah,
that's also when you're forced to take Social Security.
right.
Yeah.
So the
Ah.
situation that we don't want to be in is superannuation. I hope I'm saying that right. And
You
basically,
are.
that's when you outlive your financial resources.
Hmm.
So really understanding what that window of time is and how much money you have is critical. So you are going to have, so your issues for that is how much are you truly saving? How long are you saving? So if you start saving at 20 and you retire at 70, you've got 50 years of accumulation and that compounding interest working for you and your
Hmm.
investment returns. On the other hand, you start saving at 50, you retire at 20, you've only, or at 70, pardon me, you only have
If,
20 years. So that amount of time for how much compounding work interest can work in your favor also is going to be dependent on how long you have in this accumulation period. I thought this was interesting. So I put together a little graph
ooh.
and I said, if you are making, and I think I put it at, oh, I want to say, let me see, $70,000. And I
Okay.
said, okay, you get an annual rate raise of 2% every year. Okay. And it's not realistic because you're probably going to jump jobs. You're going to have
Yeah.
different,
Yeah. But
but they're not
if
going to
you,
be smooth raises. They're going to be like leap steps.
yep.
Okay.
Yep.
So I took away the leap steps. I said 6% savings, the idea of 3% and then you get 3% match from your employer. And an investment rate, I chose 8%. I know the S&P is looking at an average of 10%, but I'm taking into consideration market downturns and I'm also taking into consideration some people might have a mix with fixed income in there. Okay. And so what we ended up with at the end of all of that is a little bit of savings over $900,000. And that's going from 25 to 60. $900,000 doesn't feel like enough money. I think the rule of thumb is now $2 million.
Hmm.
Or even I thought maybe it was $1 million. I think the rule of thumb was $1 million. And that's based on the number of years and a 4% drawdown every single year. Okay.
You could, you can pull 40,000 out a year from that and pretty
And
much be
it
okay.
and it
Yeah.
feels weird because if your house isn't paid off, $40,000 just doesn't go very
It's not
far.
going to get you very far at all. But yeah, that I used to work with somebody who said their number was 6 million.
I feel like
I
that
don't,
is it's
that's
a
a
hard
nice
number to
number.
get to.
Yeah.
Yeah.
That's a nice number. Yeah. I yeah.
And so I wanted to speak very briefly about this diversification. So traditionally, when we think about portfolio diversification, when you're 25, the recommendation I think is 80% in equities, 20% in bonds, and 0% in cash versus when you're much older or 65, you're looking at roughly 50% in equities, maybe 15% in cash, and then 35% in bonds. So that distribution is going to change, which
Mhm.
then will also lower that rate of return that you should theoretically be getting on your portfolio. And that's going to change again as you get even older and deeper into the distribution phase. And this is just because this is one of my soapbox topics. So for those who have not
People
been
aren't saving
watching,
enough, and people are
yes,
dry. As we, to just throw current market situation into the mix here, we're speaking in late August of 2025, and the consumers seems to be kind of strong. Well, you can see one of the reasons that the consumer continues to be kind of strong. It's because they aren't saving as much,
right.
and
We
they are
are
drawing down, and they are net drawing it down their savings as well. A lot of people are.
right.
So.
So again, that's one of the reasons why I had to throw this up. This has
Mhm.
been a challenge this is something I would like to see change in our society. So we are looking at in the, what is it, mid 70s. Let me grab the pen. In the mid 70s, we're looking at over 15%, like maybe closer to 17% right here of a savings rate versus right now we're looking at saving a little under 5%. COVID was our blip, and that was partly because we couldn't go anywhere. We
And
were getting government
and
stimulus checks. We couldn't go
yeah.
anywhere. We had supply distribution issues. We weren't spending money.
Mhm.
If we had the opportunity to spend money, I feel confident we would have spent that money. We just, because of external forces, we couldn't. So again, as a whole in our society, we don't save the way that we used to. And if you've seen the tariffs, oh my video, that's a recurring theme that we talk about is the idea that our society really needs to change from a consumer nation to a saving nation.
An investing nation. There's a bet. I heard somebody put it as an investing nation on a
Yeah.
podcast this morning, and I like that a little bit better.
And so as a result, we also now have to introduce this idea of risk versus reward. And we'll speak very briefly about this. We live in a world where we count on two things, return and risk. And we want high returns and low risk because investors demand to be properly compensated for risk. If they are not, Dr. Rowe, will the investor buy the asset?
If they're not properly
Compensated.
they should not.
They should not.
They should. I'm not gonna say that they won't because I
Well,
focus
yeah.
on behavioral finance, which is people making mistakes all the time.
Well,
So
and there's something to be said for slick packaging
yeah.
because we're
So
starting to look
I'm
at some
not,
other
yeah,
products that
yeah.
if it's packaged nicely.
So I'm not going to say that they won't. I'm going to say that they shouldn't.
Right.
That's the best way because they shouldn't.
They
Because
shouldn't.
odds are, whatever risk they're taking on, if they're not getting properly compensated for it, there's something else they can invest in with the same risk that will have a better return. Period.
And this kind of, and again, we don't have a whole lot of time to really spend on
Mm.
this, but when we think about new products that are being offered and created and introduced to the public. And I'm thinking back to like when mortgage-backed securities came out, one of the challenges and one of the reasons why these became out of hand is people didn't understand the true risk involved with the security.
Mhm.
So that's something, if we're getting back to your behavioral finance aspect of it. If you don't understand the product, you're not going to understand if you are really being properly compensated.
Exactly.
Again, just looking at different types of asset classes. Small caps have lots of different return. Well, it's interesting to me when I looked at this, historically speaking, the returns on small cap are not that much greater than the returns on large cap, but wow, are they significantly more risky?
In fact, this is something that I've been talking about in the consulting that I've been doing, and this is not just a U.S. phenomena. Um, over a long period of time, small cap stocks have outperformed large cap stocks. But if you go back just over the last 20 or 30 years, large cap is now outperforming small cap. I used a start date of the last day of 1989 and compared the Russell 2000 to the S&P 500. And about a year and a half ago, the S&P 500 performed. They flipped.
So I'm
So I don't think small cap factor is a good factor anymore.
I agree.
Uh, and especially and as you mentioned, I mean, looking at that small cap return, which is only a percent or two higher than the large cap return, but you've got, basically the risk, the standard deviation is more than 50% higher. It's above 30% versus 20%. If you really need to make a little extra returns, don't go into small caps, just leverage your large caps a bit.
Sure.
That would be the proper thing to do.
And I'm going to ask you a question. I'm going to put you in the spot.
Hmm.
Who won the uh what is it? Not World Series, World Championship in basketball in 1989.
Was that the Bulls?
No.
It wasn't the Bulls. Who was it?
No, they
Oh,
won in 19 I'll give you a clue. The Bulls won in 1991 and the team that won in 1989 did one back to back with 1989 and 1990.
was it San Antonio?
It was the Detroit Pistons. The
Was it the
bat.
Pistons? I thought they had, never mind. Oh well.
Yeah.
You know what? I was thinking 89, 90 was between like the 3 and 3. It was before the
Oh
three and
no.
three, right?
Yeah, it was
Okay.
before the 3-3.
I
So
was
the
getting my
Bulls
years
won their
mixed up.
first championship in 1991.
Hmm. You probably know the exact date.
I don't.
Okay.
I wish I did. Okay, so our retirement needs. During the distribution phase, some of our expenses are going to decrease while we're going to have an increase in other expenses. So our decreasing expenses are going to be our savings. We no longer need to save that 6% every year. We no
Right.
longer have FICA payments. Hopefully, we don't have mortgage payments. Our income taxes should go down. We shouldn't be spending a lot more money on suits to go into the office, hopefully. Um, Car costs should theoretically go down, but I put in there insurance because I think insurance actually goes up as you
Mhm.
age. Um, are increasing expenses. And I want to take this with a grain of salt. This is for retirement planning. So we have
Mhm.
some basic assumptions that these are individuals who are proactively thinking about how to prepare for this stage of their life, as opposed to people who didn't have much flexibility to be able to save during their lifetime. So some of these things, these increasing expenses like vacation or a second home, lifestyle, spending money on family members. Say, mom, dad, don't look at me, right? So different expenses that
Yeah.
come up almost feel like luxury items. The things that aren't are healthcare and inflation. You might be in a
Hmm.
situation where you are fighting inflation because you're not making more investments. You're not
Hmm.
overcoming what's happening in inflation. And healthcare costs are some costs to some extent that you can't control. And these could
And
be, go
mhm.
on.
I was going to say, and healthcare inflation is greater than the baseline inflation.
So these are
Yeah.
expenses that we need to compare and contrast,
Hmm.
especially when we're looking at our decreasing costs. We also now have, on the other hand, increasing expenses. So we also want to start thinking about our wage replacement ratio, which is our expenses in retirement divided by our pre-retirement income. And this is going to give us an idea of how
Huh.
much really we need to be generating. You know how much I just love the Fred. I love data from here. So these are our expenditures, and we can see that, and these are the expenditures from 25 to 34-year-olds. And I think this goes hand in hand with that lack of savings. So when we think about our pre-retirement income, some of these numbers are starting to become inflated because we're spending so much more. So
Mhm.
you need to have salaries that are going to be able to cover those expenses. And that's one of the reasons why we have such low savings rates. I just love the Fred.
Yeah.
So sources of income, and this is going to be what I pulled this, I want to say from and I'll make sure to publish when we publish this. This actually comes from the written document from the URSA report. Okay, so this is documentation on looking at what's actually happening in the economy with regards to retirement. So the sources of income and what has me concerned is that Social Security is such a large percentage. So people are really dependent on generating that Social Security. So our assumptions, we have some assumptions with our wage replacement rate, our life expectancy, our earnings rate, and our inflation. And when we start to think about determining the need, we're going to need to figure out really how much money we have today. We're going to have to make an assumption for our rate of inflation, how long we're going to invest, and then we're going to have to, we can use all of that information to figure out that lump sum for our wage replacement ratio, and then we can back out that savings amount that we actually need. And that's critical to be able to really fully see the development of that accumulation phase. Okay, so we could also have uneven cash flows. Okay, and that will be very calculated similar to the annuity, only this time around when we use the look at calculating that rate, we're going to back it out from a net present value standpoint. And we're going to be able to use that to be able to pull out that interest rate. For those of you who are looking to do this manually, if you have a financial calculator or have Excel, you can use Solver to come up with this value for that rate. We can also look at a capital preservation model. We can look at one of my favorites, the purchasing power model. And this is utilized heavily in foreign exchange in really understanding how much money and how far your money will go in retirement given the amount of ability to use those dollars. So this is where inflation can really start to erode, and you'll see that
Yeah.
come up in the purchasing power. And the capitalization of earnings, how much are we able to capture from dividend payments and things like that outside of our traditional just savings? So when we think about purchasing power, we're looking at today. We're also looking at the immediate tomorrow, how much could we generate, and then we're thinking about the last period for our future. We're thinking about how much is our dollar going to each of these standpoints. So if we have an erosion of the value of a dollar and a dollar only buys us 60 cents in 30 years from now, we're going to need to now make sure that we save up substantially more so that we can be whole to that $1. And again, the capitalization of earnings, it's making sure that that dollar is truly the same again today, tomorrow, and then sometime in the future. And this is, we're getting towards the end, but this is where I know I personally geek out. This is where you start to play around with some of that sensitivity. How sensitive are all of these models to those inputs that you're putting in? So one way we can look at this is looking at range estimates. And this is the idea of, okay, 6% savings to 8% savings. We can then manipulate the model and say, okay, if we invest in 7% and we then tinker with the inflation rate, what will our final amount be? And then simulations or a Monte Carlo simulation, we then allow for the manipulation of multiple variables all at once, and we run different scenarios on this. And that concludes the accumulation phase. If you would like to get a hold of us, please reach out via our website, our YouTube, our email, and our Twitter account. Yay! If you enjoyed this video, please hit like. And if you have not already, please subscribe. Thank you.
Click.